Imagine this. Apple's stock is trading at $150 today. You pay a small fee for the right to buy it at $150 anytime in the next month. A week later, the stock jumps to $170. You sell that right and pocket the difference, without ever owning the stock itself. That's the power of options. But here's the catch. Some traders use them to make life-changing profits while others lose everything in days. So, what makes the difference? By the end of this video, you'll know exactly how options work, why they're priced the way they are, the safest strategies to start with, and the mistakes you absolutely must avoid. This is BytePlain, where we make money, business, and investing simple enough for anyone to understand and use. Today, we're breaking down stock options, calls, puts, pricing, strategies, risks, step by step, so you can finally understand them and decide if they fit into your investing toolkit. Let's start with the basics. What an option actually is. An option is a contract. It gives you the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. There are two main types: call options, the right to buy; put options, the right to sell. Example: you buy a call option for Tesla with a strike price of $200 expiring in 1 month. If Tesla rises to $220, you can buy at $200 and instantly have $20 per share in profit potential. A put works in reverse. Let's say you own a stock that's at $50, but you're worried it might fall. You buy a put with a strike price of $50. If the stock drops to $40, your put lets you still sell at $50, protecting your downside. But here's the big question. How is the price of an option actually decided? Before we dive into pricing, you need to understand some essential terms. Strike price. This is the set price at which you have the right to buy or sell the stock. It's the anchor of your option contract. Expiration date. The deadline to use your option. After this date, the contract becomes worthless. American versus European style. American options can be exercised anytime before expiration, while European options can only be exercised on the expiration date. Moneyness. This shows whether the option currently has value. In the money. Already profitable based on the stock's current price. At the money. The stock price equals the strike price. Out of the money. No current value, but could become valuable if the stock moves. With these basics down, you're ready to see what actually drives an options price. An options price is made of two parts: intrinsic value, how much it's worth if exercised right now; time value, the extra value from the possibility the stock will move before expiration. Here's the catch. Time value decreases every single day. This is called time decay, or theta. As you get closer to expiration, options lose value faster. The other big factor is volatility. If a stock moves a lot, options cost more because there's a higher chance they'll end up in the money. This is where implied volatility comes in. It's the market's prediction of future movement. And then there are the Greeks: delta, gamma, vega, theta, rho, that help traders measure risk and potential reward. Knowing this helps you choose strategies that fit your goals. Let's look at a few of those next. When you're new, it's tempting to gamble with risky trades and chase fast profits. But smart traders know it's better to start slow, with safer, beginner-friendly strategies that limit losses while you learn. Protective put. Think of it like buying insurance for your stock. You own the stock, and you buy a put option to protect it from big drops in value. If the price falls sharply, your put cushions the blow. Covered call. You own shares and sell a call option to generate extra income. If the stock rises above your strike price, you sell your shares at that price, but still keep the option premium as profit. Vertical spread. You buy one option and sell another at a different strike price. This reduces both your risk and the cost of entering the trade. These strategies let you practice the mechanics of options while capping potential losses. But remember, even low-risk trades can turn bad if you skip risk management. Always have a plan before you enter the market. Options give you leverage. You control a larger amount of stock with far less money than buying shares outright. This leverage means the gains can be huge in percentage terms, but the losses can also be swift and severe. Two of the most common ways beginners lose money are time decay. Options lose value as they approach expiration, even if the stock doesn't move. Wait too long, and your option can shrink to zero. Volatility crush. This happens when you buy an option before a major event, like earnings, expecting a big price move. If volatility drops after the event, often the case, the option's price can fall sharply, even if the stock moves in your favor. For example, a trader buys out of the money calls before earnings, anticipating a rally. Earnings beat expectations, but the stock barely moves. Volatility drops, and the option loses almost all its value overnight. Avoiding these traps means understanding how time and volatility work against you, and planning trades accordingly. Risk management is everything in options trading, and without it, even the best strategy can fail. Define your risk. Stick to defined risk trades like spreads, especially when starting out. These limit potential losses to a known amount. Position size. Risk only a small portion of your account on each trade, never more than you can emotionally and financially afford to lose. Broker requirements. Options trading often requires specific approval levels. Apply for the level that matches your actual knowledge and experience. Don't overstate your skills. Education. Read the options disclosure document. It may be dry, but it explains the mechanics, regulations, and risks you need to understand. Before committing real money, practice with a paper trading account for several weeks or months. This allows you to test strategies, track results, and build discipline without the emotional stress of losing real cash. Once you've proven your process on paper, you can scale carefully into live trades. Here's how I'd start if I were learning today, with enough detail to keep you focused and safe. Study free resources from the OCC or SIBO to understand terminology, mechanics, and risks before risking any capital. Pick one beginner-friendly strategy, like a covered call or protective put, that aligns with your financial goals and risk tolerance. Paper trade that single strategy for 1 to 2 months to build confidence, track performance, and see how it reacts in different market conditions. When moving to real money, start with very small position sizes. Treat it as tuition for your learning curve and record every trade's setup, outcome, and lesson. Review your trades monthly, identify patterns in wins and losses, make adjustments, and keep studying new material to refine your skills. Following these steps means you're building skill methodically, avoiding costly rookie mistakes, and creating a repeatable process without blowing up your account. If this video made stock options clearer, subscribe to BytePlain for more easy-to-follow investing guides you can put into action. In the comments, share what's the one part of options trading you still find tricky or confusing. Your feedback might shape our next video. When you're ready to go deeper, check out our other investing guides to see how different strategies, including options, can fit into your long-term wealth plan. Each one is designed to give you practical, actionable steps you can use right away. Thanks for watching, and I'll see you in the next one.